Welcome to Thoughts on the Market. I'm Mike Wilson, Chief Investment Officer and Chief U.S. Equity Strategist for Morgan Stanley. Along with my colleagues bringing you a variety of perspectives, I'll be talking about the latest trends in the financial marketplace. It's Monday, January 30th at 11 a.m. in New York. So let's get after it. 2023 is off to a much better start than most expected when we entered the year. Part of this was due to the fact that the consensus had adopted our more bearish view that we pivoted back to in early December. Fast forward 3 weeks, however, and that view has changed almost 180 degrees, with most investors now adopting the new, more positive narrative of the China reopening, falling inflation in U.S. dollar, and the possibility of a Fed pause right around the corner. While we acknowledge these developments are real net positives, we remind listeners that these were essentially the exact same reasons we cited back in October when we turned tactically bullish. However, at that point, the S&P 500 was trading 500 points lower, with valuations that were almost 20% lower than today. In other words, this new narrative that seems to be gaining wider attention has already been priced in our view. In fact, we exited our tactical trade at these same price levels in early December. What's happening now is just another bear market trap in our view, as investors have been forced once again to abandon their fundamental discipline in fear of falling behind or missing out. This FOMO has only been exacerbated by our observation that most missed the rally from October to begin with, and with the new year beginning, they can't afford to not be on the train if it's truly left the station. Another reason stocks are rallying to start the year is due to the January effect, a seasonal pattern that essentially boosts the prior year's laggards, a pattern that can often be more acute following down years like 2022. We would point out that this past December did witness some of the most severe tax loss selling we've seen in years. Prior examples include 2000, 2001, and 2018 and 19. In the first example, we experienced a nice rally that faded fast with the turn of the calendar month. The January rally was also led by the biggest laggards. The Nasdaq handsomely outperformed the Dow and S&P 500 like this past month. In the second example, the rally in January did not fade, but instead saw follow-through to the upside in the following months. The Fed was pivoting to a more accommodative stance in both, but at a later point in the cycle in the 2001 example, which is more aligned with where we are today. In our current situation, we have slowing growth and a Fed that is still tightening. As we have noted since October, we agree the Fed is likely to pause its rate hike soon, but they are still doing $95 billion a month in quantitative tightening, and potentially far from cutting rates. This is a different setup in these respects from January 2001 and 2019, and arguably much worse for stocks. A Fed pause is undoubtedly worth some lift to stocks, but once again, we want to remind listeners that both bonds and stocks have rallied already on that conclusion. That was a good call in October, not today. The other reality is that growth is not just modestly slowing, but is in fact accelerating to the downside. Fourth quarter earnings season is confirming our negative operating leverage thesis. Furthermore, margin headwinds are not just an issue for technology stocks. As we have noted many times over the past year, the over-earning phenomenon this time was very broad, as indicated by the fact that 80% of S&P 500 industry groups are seeing cost growth in excess of sales growth. Bottom line, 2023 is off to a good start for stocks, but we think this is simply the next and hopefully the last bear market rally that will then lead to the final lows being made in the spring, when the Fed tightening from last year is more accurately reflected in both valuations and growth outlooks. Thanks for listening. If you enjoy Thoughts on the Market, please take a moment to rate and review us on the Apple Podcast app. It helps more people to find the show.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.